Howdy, everybody. Welcome to Liberty Call. What day is this? Thursday, October 31st, 2024. Happy Halloween, everyone out there. Hope you're having a fantastical day. It is a beautiful day again here in Colorado. A little chillier than what we would like, but in the 30s, 40s, somewhere like that. But I will take it. It is nice, and although it's killing all the leaves on my trees, and we went from leaves everywhere a few days ago, and now they're all over the ground. So anyways, hope you're having a great day out there. If you could do me a favor before we jump into the numbers, if you could give me some thumbs up, a like, share, subscribe, and follow, and press the notification bell. All right, let's get into the markets. Dow Jones was down 0.9%, 378 points, closed at 41,763. S&P 500 down 1.89%, 109 points, closed at 5704. NASDAQ down 2.81%, 522 points, closed at 18,085. The VIX was up 13.81% today. Canada down 1.43, Brazil down 0.69, Mexico down 0.45. Let's go to our friends in Europe. Germany was down 1.03%, the UK down 0.61%, France down 1.05%, Netherlands down 0.8%, Spain down 0.36%, Italy down 0.64%, Switzerland down 1.58%, and Portugal, weirdly, up 2.21%. Strange. Russian exchanges back in the red today. MOEX down 2.13, RTSI down 2.1. And the overnights, starting out with the Nikkei in Japan, it was down 0.59%. Australia down 0.25%. New Zealand down 0.83%. In China, the Shanghai was up 0.42%. The Shenzhen component up 0.57%. China A50 down 0.47%. DJ Shanghai up 0.54%. Hang Seng down 0.31%. And the Taiwan weighted when it closed on the 30th was down 0.46%. All right. Good stuff. Seems like everyone is in less than a exciting mood about the markets. So let's dive into the market recap and see what happened. Wall Street extends losses as Meta, Microsoft highlight AI costs. All right, get to my notes. Go up to the top. All right, here we are. U.S. stocks declined on Thursday as rising costs in artificial intelligence investments by major tech firms, Microsoft and Meta Platforms, raised investor concerns about profitability. Despite both companies beating earnings estimates, Microsoft fell 5.6% and Meta dropped 4.5%, leading to a broader slump among the so-called Magnificent Seven tech stocks, basically what's been holding up the S&P 500 for the last year plus. Let's see here. Amazon and Apple, which are set to report earnings soon, also saw declines, along with Alphabet, which fell 1.7%. Investors are cautious about these tech giants. Investors are cautious as these tech giants indicated open-ended budgets, and that's in quotes, for AI spending, suggesting significant near-term costs. Carol Schlief from BMO Family Office noted that while AI advancements could boost U.S. productivity and growth long-term, investors are more focused on immediate returns. Rising capital expenditures from AI investments are impacting perceived profitability, and this, combined with a rise in the 10-year Treasury yield to 4.3%, exerted additional pressure on equities. In economic data, the Personal Consumption Expenditures Price Index, the Fed's preferred inflation measure, rose in line with expectations, with core inflation slightly above forecasts at 2.7%. Consumer spending also exceeded expectations, keeping markets expecting a 25 basis point rate cut at the Fed's November meeting, which is on the 6th and 7th. So Wednesday, is that Wednesday and Thursday next week? Is that right? November 6th and 7th. I'm sorry. Yeah, Wednesday, Thursday. Looking at the wrong month. Let's see here. The tech sector experienced a significant decline, with the Information Technology Index down 3.4%, while chip stocks dropped 4.4%, led by a sharp 19% fall in monolithic power systems. NVIDIA also declined 4.6%. Other sectors saw mixed performances. ConocoPhillips and Entergy posted positive results, boosting energy and utilities. Market volatility increased, with the VIX reaching its highest level since September as investors braced for ongoing earnings reports, the upcoming presidential election, and the Fed's policy meeting. High-profile declines included Estee Lauder, which plunged over 20%, and Uber down 11.4%, contributing to the broader market downturn. So, even though the quarterly reports that came out of these big tech firms still look pretty good and their profitability is on track, they're worried that they're spending too much on AI. So we shall see. All right, next up, let's get into some data. September personal income and consumption report from First Trust. Mr. Andrew Opdyke is the senior economist who put this together. The latest U.S. economic data offers the Federal Reserve a final look at inflation and other economic indicators before its upcoming policy meetings. In September, the PCE, Personal Consumption Expenditures Price Index, rose 0.2%, translating to a 2.1% increase over the past year, down from 3.4% in September of last year, 23. Core inflation, which excludes food and energy, was up 0.3% for the month and 2.7% year over year, also showing improvement from 3.7% in the previous 12 months. The slowdown indicates that the Fed's tighter monetary policy in 2023 and 24 is having an impact, although current monthly inflation rates still exceed the Fed's 2% annualized target. Analysts caution that rate cuts should be measured to avoid reigniting inflation. Income and spending data were also robust. Personal income rose by 0.3% in September, up 5.5% over the past year, with private sector wages increasing 0.4% monthly and 6.4% annually. Government pay is also up sharply, 6.7% year over year, the highest in decades. However, this rapid growth in government spending and pay is viewed as unsustainable and potentially detrimental to economic stability. Who says things like that? This guy, someone who's actually into Austrian economics. Consumer spending rose by 0.5% in September, driven by a 0.5% increase in spending on services, up 7% year over year. Spending on goods increased more modestly at 1.6% annually. After adjusting for inflation, real consumption rose 0.4% for the month. In the labor market, initial jobless claims fell by 12,000 to 216,000, with continuing claims down by 26,000. On the housing front, pending home sales surged 7.4% in September, suggesting a rise in October's existing home sales, although levels remain low by historical standards. The overall data highlights a resilient economy with moderated inflation, providing the Fed some leeway for rate decisions. Yeah, I don't think the Fed should have lowered rates. Personally, I think that they should have left. Well, if I was in Chairman Powell's seat at the Federal Reserve, I would have kept cranking rates up last year until we got up to, 7, 8, and really started to see get the economy to really slow down and, get to that neutral point to where then you can say, all right, where's our neutral rate for interest rates as opposed to just dropping them willy-nilly right now. So. All right, last up from Zero Hedge, homes are still overpriced, unaffordable as Fed cut sparks mortgage rate melt up. All right, let's get into this. Following the Federal Reserve's recent 50 basis point cut in mid-September, Treasury yields have surged, signaling a possible policy error and causing mortgage rates to climb back above 7%, dashing hopes of a housing market revival. Wall Street and Main Street alike are questioning the Fed's decision as mortgage rates have become a barrier for hopeful homebuyers. Initially, the rate cut spurred optimism, driving up mortgage applications after months of stagnation. However, this optimism was short-lived. With mortgage rates spiking to two-year highs, applications have since plunged back to near record recent lows. The high mortgage rates have dealt a dual blow to homeowners by both reducing affordability and discouraging current homeowners from selling, known as the lock-in effect, where homeowners are hesitant to sell if it means assuming a higher mortgage rate. This has tightened housing supply, further constraining the market. Experts like Scott Bukta of Breen Capital believe that a mortgage rate below 5.5% may be necessary to unfreeze the market, though such a rate likely won't be seen unless a recession occurs. The market imbalance is compounded by lingering home prices from the COVID-19 lockdown period. Despite recent optimism in housing data, real estate agents report widespread price reductions as homes remain overpriced relative to buyers' budgets. The recent uptick in rates has sharply curbed buyer enthusiasm, with mortgage banker Shant Banosian noting that rates above 7% substantially reduce buyer budgets. As economic data remains robust, another rate cut may only exacerbate the problem, pushing long-term yields and thus mortgage rates higher. Buyers and investors are advised to temper expectations ahead of the Fed's upcoming meeting, as further rate cuts may worsen affordability and prolong housing market stagflation. So, In reality, the prices of homes have not really been going up over the last 4 or 5 years. If you were to price it in other assets, gold, silver, things like that, I have a chart that I've been going through with clients that well, actually I can bring it up. I still have my PowerPoint up here. Where is it? Here we are. So let me share my screen again. There we are. Let me make that a little bigger. There we are. So as we can see here, I went back to, as far as the data, I could match it up. The average price of a home, for each year versus the price of gold at the time. And as you can see, starting out in the late 60s, home prices peaked, but about 750 ounces of gold for the average house. Then it bottomed out around 1980. We know what happened between 70 and 80. There was a lot of stagflation, inflation. We went off closed the gold window, which took the dollar off the gold exchange standard and created a lot of inflation. Then from 1980 to around 2000, we had a nice uptrend in home prices relative to gold, peaked out again around the mid 700s, and then bottomed out again after the housing crash. And since then has been fairly stable between 200 and 300 ounces of gold, and has of late been trending downwards. So, home prices, in dollars, yes, have gone up quite a bit. But if you were to, price that in, an asset that doesn't, that you can't dilute, something like gold, that, prices are actually fairly stable. So anyways, that's all I had to share for today. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So feel free to give me a call. I'd be happy to help. All right. Well, like I said, that's everything that I have for today. Hope everyone has a fantastical evening, and I'll talk to all y'all again next time. Adios.